Hello students, today we will discuss some aspects on exempted income, that is some case studies. The first item that we will be considering this moment is the case study relating to partial integration of agricultural income with non-agricultural income. Actually, agricultural income is exempt from tax as central government has no authority to tax on agricultural income, but in an indirect way the government levy taxes on agricultural income by applying the concept of partial integration of agricultural income with non-agricultural income, and it is applicable to taxpayers like individual, HUF, association of persons, body of individual and every artificial juridical persons. However, two conditions are to be satisfied to apply the partial integration of agricultural income with non-agricultural income. The net agricultural income of the assessee should be exceeding rupees 5,000 per annum. Non-agricultural income of the assessee should exceed the maximum amount not chargeable to tax. So these two conditions are to be satisfied. Then steps of partial integrations. First step, we have to add non-agricultural income with net agricultural income and compute tax thereon. Then in the second step, we have to add net agricultural income with basic exemption limit available under the act and to compute tax on them. So step 1 is we have to add non-agricultural income with net agricultural income and compute tax thereon. Second step, we have to add net agricultural income and basic exemption limit and to compute tax on them. Deduct and the step 3 we have to do what? We have to deduct the value of step 1 from step 2 tax computed value, add surcharge as applicable and tax rebate as applicable under section 87A, and add health and higher education cess at the rate of 4% in value arrived at step 4. Then we are taking a live situation as a case study. Mr. Z, a resident Indian, gives the following particulars of his income for the previous year 2024-25. Non-agricultural income, it is 13,30,000, agricultural income 4,90,000 and expenses on agricultural income 180, means net agricultural income is 3,10,000, 490 minus 180. Now we have to compute tax liability of Mr. Z for the assessment at 25-26, assuming his age is 53 years or age 72 years. Computation of tax liability of Mr. Z assuming age 53 years for the previous year and for the previous year 2025-26 under the default tax regime under section 115 BAC, where maximum basic exemption limit is 3 lakh. So here first we take non-agricultural income 13,30,000, it is exceeding the basic exemption limit of 3 lakh, so first condition satisfied. Then net agricultural income, it comes to 3,10,000, 4,90,000 minus 180 expenses on agricultural operations, it is exceeding 5,000 per month. So second condition is also satisfied, so partial integration of agricultural income is applicable for levying tax on non-agricultural income at a higher rate. Now step 3, tax under step 1 minus tax under step 2, it is 1,82,000 minus 15,000, that is 1,66,500. Then tax liability 1,66,500 plus surcharge, as it is not exceeding 50 lakh, no surcharge, plus health and higher expenses at the rate of 4% comes to 6,660, total 1,73,160. Now in situation 1 also, that is computation of tax liability of Z 53 years old for the assessment at 25-26 under normal provision of income tax, that is where the assessee assumes or opted old tax system regime, old tax regime instead of default tax regime. So in that case, your non-agricultural income is 13 lakh 30, net agricultural income is 3 lakh 10, then partial integration is applicable. Step 3, tax computed in step 1 minus tax computed in step 2, that is 3 lakh 4,500 minus 24,500, it comes to 2 lakh 80,000. Then tax liability, tax as computed net 2 lakh 80,000 plus surcharge not applicable as income does not exceed 50 lakh, and add 4% cess, it comes to 2 lakh 91,200. Now if situation 2 where tax liability is due computed of Mr. Z, age is 72 years instead of 53 years under default tax regime, the rate of tax or the amount of tax liability will be the same whether the age is 53 or 72 under the default tax regime, that is earlier we have computed 1,73,160, and in case of Mr. Z, age 72 years, step 3, tax under step 1 minus tax under step 2, or rather we can say excess of tax in step 2 over step 1, that is 3 lakh 2,000 minus 32, that is 270, and the tax will be 2 lakh 70 plus surcharge nil because not exceeding 50 lakh plus 4% education set, it comes to 280,800. So you see that for the age of Mr. Z, 53 years or 72 years under old tax regime or new tax regime, the taxes under the concept of partial integration will be payable as follows. Now we will be taking another issue, case study on sum received by a co-partner from Hindu undivided family or by a partner from a firm of LLP. Example, we take Mr. Ramesh received 54,000 from HUF where he is a member, that is co-partner. So tax treatment of the above in the hands of Mr. Ramesh, what will be? Mr. Ramesh received 54,000 from the HUF where he is a member. So under section 10 to it is totally exempt from tax. Again, Mr. Horiram, a partner in a firm, received 3,40,000 as remuneration as share of profit from the firm and also 12,000 as commission. Discuss the tax treatment of the above in the hands of Mr. Horiram, who is a partner of a firm. The receipt of remuneration 3,40,000 and commission of 12,000 by Horiram is taxable income of Mr. Horiram because it is remuneration, not share of profit. However, the receipt of which 65,000 as share of profit of Mr. Horiram from the firm is totally exempt from tax under section 10 2A. Case study on allowances on perquisites paid or allowed outside India by the government of India to a citizen of India. Here we see Mr. Agarwal, a citizen of India, posted in UK as the ambassador of India in the Indian embassy at UK. During the financial year 2024-25, he received the following income: basic salary 60,000 per month, dearness allowance 25,000 per month, perquisite 3,50,000, and security allowance 20,000 per month, education allowance for 2 children 12,000 per month. Compute income from salary of Mr. Agarwal for the assessment year 25-26. In terms of section 10(7), it is to be mentioned here that any allowances or perquisite received by a citizen of India from the government of India for rendering service outside India is totally exempt from tax. Accordingly, DA, value of perquisite, security allowance, education allowance are exempt from tax in the hands of Mr. Agarwal, but salary of Mr. Agarwal, being Indian citizen for rendering services outside India, shall be deemed to occur in India and shall be chargeable to tax as income from salary. So his income from salary taxable will be 60,000 into 12 for 12 months, 7,20,000 less standard deduction under section 16A to 75,000 as per the latest provision for the assessment year 2025-26, it comes to 6,45,000. Case study on receipt of pension. Here we take an example, Mr. Rajan, a government employee retired with a pension of 20,000 per month with effect from 1st June 23. He commits 60% of his pension for rupees 12,85,000 from 1st September 23. So discuss the tax treatment of the above for the previous year 2023-24. Commuted pension 60% of which 12,85,000 received by Mr. Rajan is government employee is fully exempt under section 10A. However, uncommuted pension, that is 20,000 per month into 3 from 1st April 2023 to 31st August 23 for 3 months, it will be considered, plus 20,000 at the rate of 40% because 60% already computed for rest 7 months. It comes to rupees 60,000 plus 60 plus 56,000, that is 1,16,000. It is taxable as salary income as it is uncommuted pension. Commuted pension is fully taxable. Mrs. Madhuja, a non-government employee retired with a pension of 15,000 per month, he commits 60% of his income from pension for rupees 18 lakh from 1st September 22. Discuss tax statement of pension of Mrs. Madhuja under section 1010A. Here you see that uncommuted pension to Madhuja fully taxable, that is from 1st May 22 to 31st August 22 at the rate of 15,000 for 4 months 60,000, and from 1st September 22 to 31st March 23 for the remaining 7 months at the rate of 15,000 into 40% because 60 commuted, that comes to 42, total of 1 lakh 2. It is fully taxable. Commuted pension received 60% for rupees 18 lakh tax treatment. If Madhuja receives gratuity also at the time of retirement, what will be the exempt amount? 1/3 of the full value of commuted pension, that is for 60% it is 8 lakh, so for 100% it will be 18 lakh by 60 into 100, 1/3 of that it comes to 10 lakh. So she got 18 lakh and exempt portion is 10 lakh, so taxable pension is 8 lakh. Accordingly, if Mrs. Madhuja does not receive any gratuity at the time of retirement, if he receives gratuity, 1/3 will be exempt. If she receives gratuity, it will be exempt up to half. In that case, it will be 15 lakh. So 18 lakh divided by 60 into 100 into half, that is 15 lakh is exempt, and out of 18 lakh, 3 lakh is taxable pension. Thus, pension exempted from tax of Mrs. Madhuja is 10 lakh if received gratuity and 15 lakh if gratuity is not received. Tax treatment on gratuity. Mr. X, a government employee, received 24 lakh as gratuity after retirement in the year 2024. He also received gratuity 6 lakh from his employer while in service. Tax treatment. Gratuity of which 24 lakh received by Mr. X after retirement is fully exempt as he is a government employee, but what he received as gratuity while in service, that is 6 lakh, it is fully taxable. Mr. Rakesh received a gratuity of rupees 70 lakh. He has been in employment for 21 years 7 months, that is rounded 22 years. The taxable gratuity will be computed as follows: complete year of service 22 months, 15 days salary based on average salary done. His average salary for the last 10 months is 1,20,000 divided by 26 into 15, it comes to 69,231. So what are the least amount? List of the following exempted. Actual gratuity received, he received 70 lakh. Then 15 days salary for every completed year of service, that is 69,231 into 22, that comes to 15,23,082, and maximum limit 20,000. So his exempt amount of gratuity is 15,23,082. and taxable gratuity is only 1,76,918. Mrs. Shukla received gratuity of rupees 9,80,000 after retirement for serving 18 years 3 months. Last 10 months salary by Mrs. Shukla rupees 90,000. So amount of taxable gratuity and exempt gratuity will be as follows. Under section 1010, completed year of service 18 years 3 months means 18 years rounded off. Average monthly salary is 90,000 divided by 2 is equal to 45,000. List of the following will be again: amount of gratuity received 980, amount of average salary for every completed year of service 45,000 into 18, that is 8,10,000, and maximum specified amount of exemption 20 lakh. So Mrs. Shukla is to get exempted gratuity of rupees 8,10,000 and the rest 1,70,000 will be taxable. Leave encashment. We take the example. Mr. Suman, a government employee, received 18,50,000 as leave salary in respect of his earned leave at his credit after retirement from government service. So as Mr. Sumon is government employee, it is fully exempt from tax. Total amount received as leave salary 18,50,000 is fully exempt from tax. Mr. Jadhav, a non-government employee, retired after serving 28 years 4 months, that is completed year of service is 28 years, and received 15,60,000 as leave encashment. Period of service rendered 24 years 4 months. He availed leave of 13 months while in service. His employer provided leave entitlement at the rate of 35 days for every completed year of service. Basic salary and DA for the last 10 months prior to retirement was 40,200. What will be the tax treatment under section 1010A? Under section 1010A, the list of the following shall be exempt from tax as leave salary received by Mr. Jadhav, amount of leave encashment received 15,60,000, cash equivalent of leave not exceeding 30 days for every year of completed service to the credit of the employee, that is leave entitlement under the act minus leave availed while in service. Actually, Mr. Jadhav employed for 25 years and he availed leave 13 months. So for 25 years his leave entitlement is 25 months minus 13 months already enjoyed. So rest is 12 months is credit, and at the rate of 40,200 it comes to 4,82,400. 10 months average salary 40,200 into 10 months average salary preceding employment, that is 4,02,000, and maximum monetary limit 25 lakh. So 25 lakh. So in that case 25 lakh. So in that case the leave salary of Mr. Jadhav is rupees 4,02,000, which is exempt, and balance is taxable, that is 11,58,000. Retrenchment compensation received by Mr. Das to the tune of 15 lakh for termination of service under a scheme approved by the central government. So in that case, as it is approved by a scheme of central government, the receipt of 15 lakh as retrenchment compensation by Mr. Das, who is a government employee, is totally exempt from tax. Mr. Ramlal, who employed in a factory for got retrenchment compensation of 12 lakh for closure of the factory. Mr. Ramlal worked for 21 years 7 months, actually rounded off 22 years. Basic salary, DA and commission taken together 23,800. Compute the exempted amount of retrenchment compensation and taxable portion of Mr. Ramlal. Computation under section 1010B. The following exemption shall be available under section 1010B for retrenchment compensation. Amount of actual retrenchment compensation received 12 lakh, that Mr. Ramlal got. Then actual amount calculated at the rate of 15 days average pay for every completed year of service, that comes to 23,800 by 26 average per day, 15 days into 22 actual year of service rounded off, that comes to 2,99,538, and maximum exempt amount 5 lakh. So the amount of rupees 2,99,500 is the least amount, that is exempt leave salary, and rest amount, that is 9,462,000, that is 12 lakh minus exempt amount, that shall be taxable amount of retrenchment compensation received by Mr. Ramlal. Case study on sum received under life insurance policy. If the life insurance policy is taken or issued before Act 2012, and if the premium paid does not exceed 20% of the sum assured, then the maturity proceed will be exempt from tax. In case of policy issued after 1st April, the premium paid should not exceed 10% of the sum assured, and in that case maturity proceed will be exempted. Here on an example, on 1st June 2021, Mr. Sen received maturity of rupees 15,30,000 in retirement bonus from his LIC policy, sum assured 10 lakh, and policy was taken on 1st June 2003. So it was taken before 1st 2012, it was taken before 1st April 2012. Mr. Sen paid LIC premium of 1,80,000 every year for the policy term of 8 years. So in that case it is seen that the payment of LIC premium of rupees 1,80,000 does not exceed 20% of sum assured. Sum assured is 20%, 10 lakh into 20%, that is 2 lakh, it is not exceeding. So entire maturity proceed of 15 lakh 30,000 is fully exempt from tax under section 10(10)(d). A sum of rupees 25 lakh as maturity proceed on a policy of rupees 20 lakh HDFC life policy was taken on 1st April 2013. Crucial date, it is taken after 1st April 2012. So if the premium paid does not exceed 10% of the sum assured, it will be exempt. But if it is received after the death of the insured, then it will be exempt. Here what happened? The sum was received by the legal heirs of the deceased insured, that is in whose life it was taken, that is Rajat was the person in whose name the policy was taken. So in this case, the receipt of rupees 25 lakh by the legal heirs after death of the insured Rajat shall be exempt from tax under section 10(10)(d), though premium paid 3 lakh exceeded 10% of the sum assured of the policy, because premium was paid 3 lakh and policy value sum assured 20 lakh, 10% comes to 2 lakh. So premium was paid above 10% of policy value, but still full amount is exempt because the sum, maturity sum was received not by Mr. Rajat, but after his death it was received by his legal heir, so it is totally exempt. On 1st October 2011, Mr. Hussain received maturity payment of 16 lakh including term and bonus from LIC, sum assured 12 lakh, and policy taken 1st June 2005. So it means it was taken before 1st April 2012. So in that case, policy premium should not exceed 20% of the sum assured. LIC premium paid by Mr. Hussain 2,50,000 every year during the policy term. So what will be the nature of exemption here? The LIC policy of Mr. Mohammad Hussain taken before 1st April 2012 and premium paid by him 2,50,000 per annum, which exceeds 20% of the sum assured of his policy, that is 12 lakh policy. 12 lakh 20%, it comes to 2,40,000, but he paid 2,50,000 per annum as premium. So there will be no question of tax exemption under section 10(10)(d). TDS at the rate of 5% will be deducted from the total amount received if the maturity proceed exceeds 1 lakh as per section 194(da). Thus TDS at the rate of 5% comes to 5% of 16 lakh, that is 80,000, and after deducting that, Mr. Mohammad Hussain is to get 15 lakh 20,000 net from the LIC as maturity proceed, because maturity proceed is received by Mohammad Hussain, who is alive. A study on exemption of house rent allowance. House rent allowance is the allowance given by employer to employee to meet the cost of accommodation. Under section 10(13)(a) and rule 2A, the least amount is of the following three: actual HRA received, 50% of salary if the place is Kolkata, Bombay, Delhi, Madras, 40% for other places, and excess of rent paid over 10% of salary. Here we see that Mr. T got house rent allowance at the rate of 4,000 per annum. So actual HRA received 4,000 into 12, 48,000. He took accommodation at Calcutta and rent paid 5,000 per month. So here place is Calcutta, so rate will be 50% of salary. Here salary means basic salary, that is basic salary is 20,500 into 12 plus DA. As it enters into return benefit only 60% to be considered. So 5,000 into 60% into 12 plus commission, no commission, so only these two aspects will be coming, that is 2,46,000 basic salary and applicable DA for this purpose 36,000, 50% of that it comes to 1,41,000, and excess of rent paid over 10% of salary, that is he paid in rent of 5,000 per month, that is 5,000 into 12, 60,000 minus salary 10%, that comes to 2,46,000 plus 37, 10% that. So taken together he paid actually above 28,200. So of these three, 28,200 is the least amount and it is the exempt amount. So exempted HRA is rupees 28,200 under section 10(13)(a) and the rest is taxable. exemption in case of clubbing of minors income. In case of clubbing of minor income under section 64(1)(a), where income of any minor is clubbed with the income of any of the parent of that minor, it is allowable, but a tax exemption is allowed under section 1032 for clubbing of income of minor, subject to a maximum of rupees 1500 per month per child. That is, exemption cannot exceed 1500 per month. Here is an example. Income of minor daughter of Mr. Das is rupees 2400, which was clubbed, and also income of minor child of Mr. Das of rupees 3000, which was also clubbed with the income of Mr. Das by virtue of section 64(1)(a). So what is the amount of exemption available under section 1032? Here we see minor daughter exemption amount shall be 1500 per annum under section 1032, and for minor son exemption shall be limited to 1300, because exemption cannot exceed the income clubbed. Here income clubbed is 1300, so 1500 cannot be claimed for exemption. So total exemption will be for minor daughter 1500 and for minor son 1300, total to the tune of 2800 under section 1032. Case study on tax holiday for SAGE units under section 10AA. Tax exemption or tax holiday provided to newly set up industrial or business units as SAGE units for their export is provided under section 10AA to promote export. Here is an example. The turnover of Z Company Limited for its business located in SAGE for the previous year 23-24 amounted to rupees 2,80,000. Profit of Z Company Limited for the previous year amounted to 60 lakh and export turnover is 84 lakh. Discuss the amount of tax exemption available to Z Company Limited under section 10AA, assuming Z Company Limited was established in the financial year 2019-20, means after 2005 but before 1st April 2021. So 100% export profit derived from export operation of Z Company Limited is available under section 1010A, since assessment year 2024-25 relating to the previous year 23-24 falls within a period of first 5 years of commencement of such operation. Therefore, the exemption amount will be 100% of export profit of Z Company Limited will be exempt under section 10A. That shall be SAGE units total profit 60 lakh divided by SAGE units total turnover to 280 lakh multiplied by 84 into 100%, it comes to 18 lakh. So 18 lakh shall be the exempted amount of export profit by virtue of section 1010A in the hands of Z Company Limited. We take another example. Texmac Limited has two SAGE units, Unit A and Unit B, details of which are given for the previous year 2022-23. Here we take Unit A. It started its operation on 22nd June 2014. Its total sales for the current previous year 600 lakh, export sales 480 lakh, net profit 80 lakhs. Another SAGE unit B Limited of Texmac Limited, it was set up on 10th April 2018. For the previous year 2022-23, its total sales 200 lakh, export sales 140 lakh, net profit 20 lakh. So we are interested to know what shall be the amount of tax exemption under section 10A of Texmac Limited for its two SAGE units, Units A and Unit B. First, take SAGE Unit A. It was set up and started operation 22nd June 2014. Since assessment year 23-24 is the 9th previous year from the assessment year of starting operation, that is 2015-16, the tax exemption under section 10A shall be 50% of export. It is 9th year, that is second phase of 5 years. So tax exemption will be total unit of total profit of SAGE unit A by total turnover of SAGE unit A into export profit of SAGE unit A. Total profit of SAGE unit A is 80 lakh divided by total turnover 600 lakh multiplied by export sales 480 lakh multiplied by 50%, because 50% will be the amount of profit here. So the amount of exemption for SAGE unit under section 10A shall be computed at 32 lakh exempted amount under section 10A. Now we take unit B. It started its operation on 10th April 2018. So coming to the previous year 2023-24, only 5th year exemption under section 10A in respect of SAGE unit B shall be at the rate of 100%, because it is 5th year 2022-23 from the year of starting operation. So 100% profit, export profit is allowable for exemption under section 10A. So tax exemption for SAGE unit B under section 10AA shall be total profit of SAGE unit B by total turnover of SAGE unit B multiplied by export profit of SAGE unit B into 100%. It comes to total profit 20 lakh divided by total sales 200 lakh multiplied by export turnover 140 lakh into 100%, it comes to 14 lakh. So Texmaco Limited, for its two SAGE units, unit A and unit B, it is entitled to claim exemption under section 10AA for export profit in case of SAGE A 32 lakhs and in case of SAGE B 14 lakh. Okay, thank you.